Welcome back. In this presentation, we're going to talk about capital structure after introducing one market imperfection, and that market imperfection is corporate taxes. To recap, we said that we are going to talk about capital structure, that is answering the question, what is the right mix of debt and equity finance, incrementally, which means we're going to start with a perfect capital market, and we're going to then introduce market imperfections one at a time to see how introducing market imperfections changes the result. The reason we do this is because things are hard. It's hard to understand the implications of all the market frictions in the place if you introduce them all together. And we said in a perfect capital market, it doesn't matter whether you finance with lots of debt or little debt, it won't change the value of the business and it won't change the cost of capital. But we're going to see that in a market that just has corporate taxes as a single imperfection, you are going to maximise the value of the firm by taking on all debt finance. Then we're going to introduce other market imperfections, namely costs of financial distress and conflicts of interest between shareholders, lenders and executives. And we're ultimately going to end up with a theory of optimal capital structure, a framework for executives to decide what is the right mix of debt versus equity to maximise value for shareholders. So let's get to it. Here's our agenda. Our agenda is to introduce one market imperfection, corporate taxes. We're going to revisit our CVS example. We're going to consider CVS without debt. Then we're going to introduce what we call the borrowing project. So this is where we're going to say, how does the valuation of CVS change once we make one change to introduce debt into the capital structure? We're going to look at equations for the cost of equity, and then we're going to consider the case where there is a constant percentage of debt instead of a constant dollar amount of debt, which is going to be our first assumption. So, considering one market imperfection, here's our question. In a market with one imperfection, namely corporate taxation, what mix of debt versus equity will maximise the value of the business and therefore maximise shareholder wealth? And the answer is that in a market with one imperfection of corporate tax, the business should finance with almost 100% debt. Now, I say almost 100% debt, you have to issue one share. Otherwise, our theory of capital structure, debt versus equity, doesn't make sense, right? It doesn't make sense that you could finance the business with entirely with debt finance, because that basically becomes the ownership of the business. Now, we know that companies don't actually do this because of other market imperfections that are going to be introduced later. So, for instance, utilities have lots of debt. Why does a utility like DTE Energy or Consumers Energy have about 50% debt to debt plus equity? Well, that happens because these companies have assets that have value which is maintained even if the business gets into financial distress. The value of the assets is maintained regardless of who owns the asset. So yes, a utility can go bankrupt if earnings fall below the point at which it can repay its lenders, but then the lenders take control of the assets. They could sell the assets to someone else or become the shareholders, but the value of the utility is unaffected by this transition from one owner to the next. People still switch on the gas, people still switch on the electricity. I don't know who the shareholders are in DTE. I don't know who the lenders in DTE, and as a consumer, I don't care. I buy the service, DTE sells the service, and basically the executives of the business run it the same, regardless of who owns the business. In other circumstances, though, the value of the assets is not maintained if there is some shock to the business. And these businesses typically have lower leverage. So you take, for example, a business like an early stage technology company. An early stage technology company, it could borrow, but as a lender, I would be reluctant to lend to that early stage technology company because it may have valuable technology, but if there is a shock to the business that causes the value of the assets to decline, there doesn't appear to be something that the lenders can sell for high value if they then take control of the assets. So in the event of financial distress, ultimately proceeding to bankruptcy, the lenders have control of the assets. The lenders aren't in the business of running the company. They could take the shares in the company, but what are the shares worth? Right? There's been some shock to the business. Can you sell an early stage technology company to another party for a high price? You probably can't, because whatever caused the shock has ultimately destroyed the value of the business. So as we progress through the discussion, we're going to talk about economic distress and financial distress. For a utility, if it becomes financially distressed because it took on too much debt, that doesn't necessarily mean that it is in general economically distressed. It might have positive profits at the earnings before interest and tax line, but not enough profits to make the interest payments. For a technology business, if it's financially distressed, so it can't pay the lenders, it's probably also economically distressed. So it doesn't even have positive operating profits even before interest. So in the event that that company becomes distressed, there's probably not much of value that the lenders can sell in the event of default. And this is the basic reason why some companies have low debt and some companies have high debt. The companies with high debt have assets which have value which is maintained even if they become financially distressed, provided that they are not economically distressed. But we're going to consider those things later. Right now, we're just going to consider one market imperfection, and that's corporate tax. And we're going to see with this one imperfection, you maximise the value of the business by taking on all debt finance, but for the issuance of one share. And now again, to make our conclusions concrete, we're going to return to our example of CVS. We considered CVS in our last presentation with no taxes. Well, the only change I'm making in this presentation is that I've introduced corporate tax. Now remember, when we define cash flows, we start with after-tax operational profit as our first step. We've done that in every free cash flow example, right back to project evaluation. Step 2 was to reverse income statement items which weren't cash flows, like depreciation. And step 3 was to incorporate cash flows which had not yet flown through the income statement, like capital expenditure and change in working capital. So if you take the same operating profit assumptions that we had earlier and introduce a corporate tax rate of 21%, we have a lower estimate of the free cash flows and the dividends, because remember, at this stage, CVS does not have any debt. The cost of equity right now is 10%. The growth rate from year 4 onwards is 4%. The present value of the cash flows from the explicit forecast period is $18.5 billion. That's the present value of these three cash flows discounted at the rate of 10%. The value of the business at the end of year 3 is going to be the year 4 cash flow divided by the discount rate minus the growth rate. And the year 4 cash flow is the year 3 cash flow in this example, multiplied by 1.04. So in this world with corporate taxes, the terminal value is $127.2 billion. The present value of that terminal value after discounting 3 years is $95.6 billion. And the total present value of all cash flows, if you add up the present value of cash flows from the first 3 years, plus the present value of cash flows from year 4 onwards, is $114.1 billion. So to set up our example, CVS has an enterprise value of $114 billion. It has no debt, so it also has an equity value of $114 billion. To recap from our previous discussion, we said that in a perfect capital market, under Miller and Modigliani's Proposition 1, changes in corporate leverage make no difference to firm value. Another way that we wrote this was to say the value of the firm without debt equals the value of the firm with debt, or we could say the value of the unlevered firm is the value of the levered firm, which we often write in shorthand, V subscript U equals V subscript L. But now we're going to change things just slightly. We're going to introduce a new project, which I'm going to call the borrowing project. And to understand capital structure with corporate taxes, the first thing that you have to understand is the fundamentals of this idea of the borrowing project. So pay very close attention here. Our question is, what happens if the firm borrows? There are tax deductions for interest expense and nothing else changes. The fundamental discount rate discussion that we had earlier in the course is that companies can take on many projects. Each of those projects has its own risk, and when you think about projects having their own risk, you go down a path and say each project should have its own discount rate, and discount rates have to reflect risk. And that would be the case regardless of how I model risk. So I could model risk using the capital asset pricing model, I could model risk using some other framework, but the key point is that there is some sort of risk and return relationship. Now, for a company that has many projects, those projects have different risks, and the discount rate doesn't reflect the risk of the ownership of the business. It reflects the risk of the individual project. And I gave you an example of the government has a discount rate of 2%. The government borrowing rate is about 1% at the moment. So the government has the lowest cost of capital of any asset owner. And the government owns some assets like the US Postal Service, for example. Now, if you go in a pathway of saying, well, we should evaluate projects on the basis of who owns the project and use the owner's discount rate, the extension of that would be to say, well, shouldn't the government own all the projects because it has the lowest discount rate, and that would increase the value of all the projects. Now, we don't do that because there are some things that the private sector does really well, and there are some things that government does really well, and we should separate those things. The government has a role where there is some market failure, where there are coordination problems, where there are competition problems. And there are some other aspects of commerce where there's plenty of competition, there are few barriers to entry, there isn't a degree of market failure, and so the needs of consumers are met by the desire of shareholders in those private companies to be profitable. Again, you could go down a pathway of saying, well, big companies typically have a lower cost of capital than small companies. If I was to evaluate a big company like Facebook or Apple or Google or GM or Ford, these big companies are less risky than small companies. They have lower beta estimates, but they also have lower risk on a number of dimensions. They're more liquid, there's more information about those companies, they're less prone to financial distress. On a number of metrics, big companies are less risky than small companies. So if you were to think of discount rates in terms of who owns projects, the logical extension is that big companies should own everything because they have the lowest discount rates, and that would increase the value of all of the wealth because the NPV, the net present value of all the projects, would go up because they're owned by companies with lower discount rates. But that doesn't make sense because there are some projects that are best owned by small companies and some projects best owned by big companies. Big companies are really great at doing things that require economies of scale, running airlines that have massive coordination issues and you've got to buy jets or lease jets years in advance. Whereas there are some enterprises that are best owned by small companies where there isn't great economies of scale, where you need lots of local on-the-ground knowledge, where algorithms don't work so well and big logistical programs don't work really well because you've got to tailor everything to local conditions. So smaller boutique restaurant chains or smaller boutique hotel chains or smaller services business, personal training businesses, for example, are best owned by smaller enterprises. So you don't get in a pathway of saying we should value projects on the basis of who owns them. But what do we observe in practice? We often observe that a big company that has a diversified portfolio of assets will say, we want to evaluate all the projects using the same discount rate. But the companies don't do that because it's in theory the best thing to do. They do that because there's massive estimation error in discount rates. So when a company like Rio Tinto, a big mining company, looks at its suite of projects around the world, it's got a bauxite mine and an iron ore mine and a copper mine, for example, it'll say it's really hard to measure the discount rate for a bauxite mine, an iron ore mine and a copper mine and say with confidence that the risks of those three projects are actually different. And so we should use 8.5% for bauxite and 9% for iron ore and 9.5% for copper. That's a really hard measurement exercise. So there's no guarantee that you've even got the rankings of the risk correct, let alone estimate with precision the discount rates. So what you observe in practice is a big company will say, I'm not going to be concerned about estimating discount rates for these individual projects that are different across the business lines. A company like Rio Tinto will say, let's just use 8% for all the projects and be done with it, for example. And then we can focus on the business case for those projects. What are the cash flows? How can we reduce costs? How can we develop the market? How can we optimize the plants to run most efficiently? These sort of issues. A big company isn't concerned about whether the right discount rate for one division or another can be estimated with that great degree of precision. But that doesn't mean that each project doesn't actually have a different discount rate in theory. It just means it's hard to measure those different discount rates. So having established that different projects have different discount rates, now I want to introduce the borrowing project. What we're going to do is take a company like CVS and say, let's value CVS as an operational project, which is selling the pharmaceutical goods and the drugs and the chocolate bars and the other grocery items. So that's going to be the operational part of CVS. And then we're going to take the borrowing project. That's going to be the decision of the executives to decide to take on debt. And then we're going to add up the value of CVS as the sum of the parts. And so what we're going to do is say there is a value of the firm with debt. That's CVS operationally plus borrowing. And that's going to be the value of the firm without debt. Okay, that's going to be the operational part. And then the separate valuation is going to be the present value of the tax benefits that we get from borrowing. So all that's going to happen with the borrowing project is that we're going to go to a bank or some corporate bond investors and say, give us some money. Then we're going to take that money and either do a share buyback or pay a special dividend. And then after that, we're going to pay back that loan. The extra cash flows that we're going to get from this project is going to be the present value of the tax benefits that we're going to get from borrowing. So we're going to see that operationally, all the cash flows in our definition are the same, but for the fact that we are going to get a tax break by the tax deduction of interest payments. That's going to progress to an equation that says the value of the levered firm is the value of the unlevered firm. That's the same as the value of the firm without debt, plus the present value of tax benefits from borrowing, or written another way, V subscript L is V subscript U plus the present value of the tax benefits from borrowing. So we're going to end up with a situation in which we say the value of the levered firm is the value of the unlevered firm plus a bunch of extra cash that we got by deciding to take on debt. The more debt we take on, the more we are going to maximize the value of this right-hand term, and that's going to maximize the value of the levered firm. That leads to our decision to take on 100% debt finance, but for the issuance of a single share. So let's do our example. We're going to take CVS and we're going to say CVS is going to borrow $20 billion at an interest rate of 5% forever. You recall this example from the previous discussion. What are the cash flow benefits that we get from this simple borrowing decision? The cash flow benefit that we're going to get is as follows. We pay interest of $1 billion per year. That is 5% times $20 billion gives us interest expense of $1 billion. Now that doesn't affect our cash flows, but what we are going to get separately is a tax deduction each year on that interest. if the tax rate's 21% and we incur interest expense of $1 billion, that's going to reduce our tax bill each year by $210 million. So if you decide to take on this borrowing project, nothing's going to change for CVS except there is more cash in a separate project. Now, this hasn't affected our free cash flow definition that we had before. That's unchanged because that's part of our operational valuation of CVS. That's part of our value of the unlevered firm. All that's happening here is that we've taken on debt, we are going to pay interest expense, and then we are going to get a tax deduction on that interest expense every year. That's just going to create more cash for the shareholders year after year. Now you might be thinking, well, what about the interest? Aren't we paying that as well? Yes, we are, but we also use that money to make an immediate payment to the shareholders, either via a special dividend or a share buyback. So the money comes in and it's going to flow out again via these interest payments. And that money coming in and then being paid as a special dividend or a share buyback is equivalent in present value terms to the money that flows out again to the lenders via these interest payments. Those two cash flow streams are equivalent. But what extra do we get? Because of the way the tax code is written, the extra part we get is a tax deduction every single year of $210 million. Now, in this simple example, this cash flow stream is a zero growth perpetuity. And you've already worked out 2 months ago how to estimate a value of a zero growth perpetuity. We said that the value of that perpetuity is the cash flow next year, C1, divided by discount rate minus growth rate. Well, C1's $210 million. That's the extra cash we get from the borrowing project. The growth rate is going to be 0. But what's the fair discount rate? If I know the fair discount rate, then I can estimate the value of this zero growth perpetuity, $210 million forever. Well, I've got a theory as to what the discount rate should be. And it's a pretty simple theory. It's in fact not a mathematical proof, but this is where the answer comes from. If you take on a constant dollar amount of debt, and if you invoke the simple assumption that the risk of receiving a tax benefit in any year is the same as the risk of making an interest payment, that will tell us what a fair discount rate is. So suppose you take a simple situation that says, if I generate enough cash flow to make this interest payment to the lenders, remember there's still risk here, cash flow could be up or down. If I generate enough cash flow to make this interest payment, then on my tax return, I'm able to claim that interest payment as a tax deduction. If I don't generate enough income to make that payment to the lenders, I'm also not able to claim this interest expense as a tax deduction. Now, I might be able to use some tax losses carried forward, but in our simple framework, we either make the interest payment and we get a tax deduction, or we don't make an interest payment and we don't get a tax deduction. So in terms of the cash flows from the borrowing project that we're talking about, the risk of those cash flows in the borrowing project seems to be the same as the risk associated with the cash flows to the lenders. The lenders have already worked out what is a fair discount rate associated with that risk of those particular cash flows. The lenders have worked out that based upon the risk associated with CVS in our example, a discount rate of 5% is fair for the interest payments the lenders are going to receive. Well, if there's a series of tax deductions which are perfectly correlated with those interest payments, in reality they're not perfectly correlated, but it's pretty close. If there's a series of tax deductions that are perfectly correlated with those interest payments, those tax deductions are going to have the same risk as the interest payments. And if I have two cash flow streams that have the same risk attached, they should have the same discount rate. And that means that the fair discount rate to value this level growth perpetuity of $210 million each year of tax benefits is also 5%. So here is the implications. If I take on this debt via the borrowing project, I want to value the extra cash flow I get from that debt. The money coming in from the lenders is the same in present value terms as the money going out via interest payments. $20 billion came in and we use it to pay a special dividend. The present value of the interest payments going out is also $20 billion. So that's a wash. But what I get is $210 million each year of tax benefits. The present value of those tax benefits is $210 million divided by a discount rate of 5%. It's a 5% discount rate because the risk of the tax benefits is the same as the risk of the interest payments. That present value computation works out to be $4.2 billion. This is the same as just writing the amount of debt times the tax rate. $20 billion times 0.21 is also $4.2 billion. Why? We'll just work through the following quick computations. We said present value of a zero growth perpetuity is cash flow in year one divided by the discount rate. The cash flow in year one is the amount of debt times the interest rate on debt times the tax rate. That was our $210 million figure. The discount rate is the cost of debt because we said that the interest tax deduction is going to be the same risk as the interest payments themselves. So I've got the cost of debt in the numerator and the denominator, so they cancel out. So I could say the present value of the additional cash flow from the borrowing project is the amount of debt times the corporate tax rate. So that means that if I decide to take on this project, I just keep increasing the value of my business under this assumption of a constant dollar amount of debt by the amount of debt times the tax rate. And that is what's shown in these equations on the slide. Now, it's crucial that you read the heading at the top. This is going to be a valuation equation with a constant dollar amount of debt. That's going to apply to the right-hand side here. Our general equation, and this applies regardless of how you think the firm is financed, whether it's financed by borrowing $20 billion once and just having interest every year forever, or whether there's a series of bonds issued that have different maturity dates, or whether the firm restructures its debt to be 20% leverage every single year, so the leverage changes in dollar terms depending upon how the value of the firm changes. What's on the left-hand side is a general equation that always applies. It says that the value of the levered firm, that is the value of the firm with debt, or V subscript L, is the value of the unlevered firm, or V subscript U, plus the present value of the tax benefits from taking on debt. The specific equation, which holds if you have a constant dollar amount of debt, $2 billion going on forever, our example, is that the value of the firm with debt, that is the value of the levered firm, is the value of the unlevered firm, V subscript U, plus the tax rate times the dollar amount of debt. And that is based upon two important assumptions. The dollars of debt are constant, and the fair discount rate associated with those tax benefits is equal to the cost of debt itself. Those were the two assumptions that led to this equation. So let's look at how this applies to our actual valuation of CVS. And crucially though, there is a single mistake that students will make with these computations that I don't want anyone to make. It's a very common mistake, and it happens because people try to do things too fast. When they're doing a problem, they don't write things down in words and take their time with it. If you write things down in words and take your time with it and understand why am I assuming certain things, you won't make this particular error. Students often confuse the annual interest benefit, the tax deduction from interest, versus the present value of that tax deduction from interest. The annual benefit that we get is the amount of debt times the interest rate on the debt times the corporate tax rate. In our previous slide, that is what is in the numerator just here. That's the tax deduction on interest on an annual basis. D times the corporate tax rate, D times the Greek letter tau, that is the present value of all of those payments. Often what students will do is that they will conflate tau, tax rate, times the amount of debt. They will think that that is something that they're getting every single year by taking on debt. So they will grossly inflate the present value of the tax benefits from debt. So we don't want to do that. The tax rate times the amount of debt is the present value of all of the tax deductions on interest forever, assuming a firm takes on a dollar amount of debt which remains constant, in this example $20 billion, and we assume that the fair discount rate for the present value computations is the cost of debt itself. So let's apply that to CVS Corporation and see what happens to our valuation. Same cash flows as before in terms of free cash flows, but something's going to be a little bit different. The free cash flows are going to be 7.5 and 7.3 billion. That's what we had before. The value of CVS with debt is the value of CVS without debt. That was $114.1 billion. The value of the tax benefit is $4.2 billion, and that means that the enterprise value is now $118.3 billion. That's the value of CVS as an enterprise once we've put debt into the capital structure. That is VL, this is VU, and this is tau, the corporate tax rate, times the amount of debt. How is that allocated amongst the shareholders and the lenders? The enterprise value, VL, value of the levered firm, minus debt gives us equity value of $98.3 billion. Now you'll see above that there is also a lower dividend now compared to what we had before we had corporate taxes and before we had interest. Out of the free cash flow, there's going to be interest expense of $1 billion every year. There's going to be a tax deduction on that interest of $0.2 billion. That's going to be cash flow that benefits the shareholders. So what's left over to pay dividends is now going to be $6.7 or $6.6 billion, depending upon the particular year. Finally, let's see how refinancing would work in this example. Recall that I said something's going to happen with this borrowing. Either the company is going to pay a special dividend or a company is going to do a share repurchase. Now, in reality, capital structure changes are happening continuously. It's not always the case that a company says, today I'm going to borrow $20 billion and I'm going to use that instantaneously to pay a special dividend or do a share repurchase. But in our example here, we are simply saying, I want to evaluate what CVS looks like with debt and without debt and hold everything else the same. So I have to make an instantaneous change to the business. So how does the refinancing work? CVS, without doing this project, had enterprise value of $114.1 billion. With debt, it has enterprise value of $118.3 billion, and the $4.2 billion gain accrues to the shareholders in the following way. CVS has 1.3 billion shares on issue. Without debt, its equity value would have been 114 billion, same as enterprise value because there's no debt. So equity value per share would have been $87.77 per share prior to the refinancing. CVS then announces the following project. It announces that it's going to borrow money and either pay a special dividend or do a share buyback. Immediately when it announces that it's going to do this borrowing project, the enterprise value and the equity value increase by $4.2 billion to $118.3 billion. Now, no debt's been taken on yet. It's just an announcement because the market reacts in the correct way to the news. Remember, we don't have other market imperfections yet. There's no confusion in the market that this is a good idea, the market correctly works out that there are these tax benefits, the market can do a present value computation, and the market works out that the present value of those tax breaks is $4.2 billion. The shares go up to $118.3 billion. There's still 1.3 billion shares in issue because they haven't borrowed any money yet. And that means that each share, upon this reaction, is worth $91 per share. Now, that next moment, CVS borrows the money. It borrows $20 billion. It could either pay a special dividend of $15.38 per share, $20 billion divided by 1.3 billion shares is $15.38, or CVS could take that $20 billion and buy as many shares back as it could at $91 per share. And that would allow CVS to repurchase about 220 million shares. If CVS goes the special dividend route and pays all the shareholders $15.38, after that dividend is paid, enterprise value will still be $118.3 billion. $20 billion cash came in from the loan, $20 billion cash went out from the dividend, debt is now $20 billion, enterprise value minus debt is $98.3 billion. There's still 1.3 billion shares at issue because that didn't change with the special dividend, and each share is worth $75.61. As a shareholder, what you started with was a share worth $87.77. What you've ended up with is $15.38 in cash and a share that's now worth $75.61. And your total wealth is $91, just as it was upon the announcement, $91. Alternatively, if CVS does a share buyback, the shares are trading at $91 each. CVS can repurchase about 220 million shares with this money. Enterprise value is $118.3 billion. Debt's $20 billion, leaving equity value of $98.3 billion. But now there's only 1.08 billion shares in issue because 220 million shares were bought back. And each of those shares is worth $91 per share. So the shareholders who sell out in the buyback, they end up with cash of $91 billion. Shareholders who retain their shares in the company, because the pool is now being handed around amongst a smaller number of shareholders, they have shares worth $91. So every shareholder still has the same wealth. They either have $91 cash or a share worth $91 in the repurchase example. In the dividend example, shareholders all have the same distribution. They had $15.38 in cash from the special dividend, and they had a share that was now worth $75.61. So there's no better way to use this money in this world of corporate taxes because we haven't talked about any differences in personal taxes amongst different investor groups, and we haven't talked about any differential taxes between dividends and capital gains. But that's a topic for another class. It's beyond the scope of what we are going to talk about. We are going to wrap up that discussion at this point, and we are then going to move on to what this equation means for the cost of equity. Recall that the cost of equity increases as you put in leverage because of the increased financial risk to the shareholders. Well, we're going to slightly change our equation to take into account that increased financial risk.